Net profit margin, also known as profit margin or net income margin ratio, is a financial ratio used to calculate the percentage of a profit a company produces from its total revenue, total sales. It measures the amount of net profit a company obtains per dollar of revenue or sales gained. The net profit margin is equal to net profit or net income divided by its total revenue, total sales, expressed as a percentage. For instance, a 10% profit margin, net income margin, means for each dollar of sales the company earns 10 cents in net profit, net income. Okay. Revenue represents the total sales of the company in a period, so 10% margin indicates that a firm earns 10 cents out of its $1 revenue. And other common financial metrics are EBITDA, EBITDA, called EBITDA, or gross profit, or operating profit. So these metrics also show the company's profitability. Okay, high net profit margin means that a company is able to effectively control its cost and provide goods or service at a price significantly higher than its cost. Therefore, a high ratio can result from high profitability can result from efficient management, or a low cost, low expense, or a strong price policy. And a low net profit margin means that a company uses an ineffective cost structure or poor pricing strategy. So the low ratio can result from inefficient management and higher expense and a weak pricing policy. And investors need to take numbers from the profit margin ratio as an overall indicator of company profitability or operating performance, and you have to look deeper research into the cost of an increase or decrease in this ratio. If you see a high number, either a high number, a low number of net income ratio, you have to look deeper to find out why. Okay. And when calculating this net profit margin ratio, analysts or investors commonly compare the figure to different companies to determine which business performed the best. So you can compare this ratio with different firms within the different industry. There is some shortcomings. The net profit margin ratio can greatly differ from companies in different industry. For instance, the firms in the manufacturing industry may report a lower profit margin ratio compared to a firm in the service industry. So given that there are cross-industry differences in business and margin structures, it is recommended to compare only companies in the same sector with similar business models and business structure. And other limitations include the possibility of misinterpreting the profit margin ratio and cash flow characteristics. Suppose a low net profit margin does not always indicate a poorly performing company, and also a high net profit margin does not always translate to high cash flows. For instance, suppose a firm indeed make a lot of profit in cash, but they can have somewhat a lower ratio if they have a greater depreciation and amortization, which is not really a cash expense. Okay. In this case, they will have a lower margin, even though they generated a lot of cash, because they have a non-cash expenses such as depreciation and amortization. In this case, you can use EBITDA, earnings before interest and taxes, plus a depreciation and amortization. So you add back this non-cash expenses to refer the company's real profitability. Likewise, where their net profit margin is huge, but if their sales were made by receivables, they will not make cash at all. So what if they do not get paid back? So when you do a financial ratio analysis, it's important to compare various ratios with relevant peers and so on. And this too, a return on total capital relates the firm's earnings to all capital in the enterprise. So return net income plus interest expenses over total capital means let's compare these two ratios. This net income is attributable to the stockholders because net income is after the interest and taxes, right? So stockholders get 100% of net incomes. But this net income plus interest expenses metric shows the income available to stockholders plus a bondholders. And this average total capital is, let's say, a debt plus equity. So this ratio shows you how much income did you generate using your total capital from sourced from a debt holder and stockholders. So this is kind of a net income, while net income profit margin is a profitability ratio. This return on total capital can be described as a efficiency ratio, such as a return on equity, which we will talk about in the latter part. Okay, so this is the return on equity. ROE is a profitability ratio, but it's also a ratio that indicates a firm's efficiency. So return on owner's equity indicates the rate of return or earned on the capital provided by the stockholders after paying for all other capital use, such as interest expenses. So how much did you make money using your capital, using your owner's equity? Did you use it efficiently? So firms that use this capital more efficiently will have a higher return on equity ratio. So how much return, how much income did you generate from $1 unit of your equity? So for stockholders, okay, equity stockholders, so equity investor, a stockholder's perspective, how much did a firm make an income over your invested equity capital? Okay. And This is the same as a ROE, return on equity, but there are some variations to calculate this ratio. Okay, in general, we just measure ROE as a net income divided by its total equity. So this part is not really important, but some people try to measure its ROE more accurately by considering the only common equity. Okay, the common. In equity, there are two parts. There are a common shares, and the second one is the preferred shares. This common shares has voting rights. So this the holder of a common shares is a firm's owner because they have the voting right. But these preferred shares, they don't have voting rights. Since they do not have some voting rights, so they're not the real firm's owner. They get more dividend than the common shareholders. Okay, there are more dividend. Okay, more dividend. Okay, so preferred shareholders, they do not have voting rights, but they get more dividend, more payback. So they try to measure the return on equity by subtracting a preferred dividend and considering the only common equity to more accurately measure this ratio. And DuPont analysis. This methodology is called a DuPont analysis. The DuPont analysis breaks down the components of the return on equity. For instance, the ROE, return on equity, can be calculated by multiplying the net profit margin